Hey everybody, this is Gregg Gossett from Gossett Trading and Mentoring, and today is Saturday, June 11th, 2023. Hope you're doing well, and thank you so much for coming and visiting me for another edition of my Weekend Review podcast. In this podcast, I'll tell you what the format is. First of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily, weekly, and the monthly timeframes. We're going to talk about when I entered the trade, why I entered the trade, and most importantly, how I am going to manage the trade going forward, either to the upside or to the downside. After that, we're going to do a little segment on trader psychology. Always the most important skill is the ability to create a plan, follow your plan without letting the gains or the losses interrupt your process. It's always helpful for me to do this segment on trader psychology, and I hope it's helpful for you as well, because it really is the most important part of trading. It really is. I've been trading for 28 years, and having wins, you start feeling bulletproof. Having losses, you feel like you're never going to make another penny again. And trust me, you will make more money again. If you're on a winning streak, there will be losing periods ahead. That's just part of the game. After that, I have gone down through my master watch list, both on the daily and the weekly time frames, and I will show you what I'm looking for next week as far as those markets getting to particular levels. In general, my trading approach is I like to see major levels rejected to the downside if I'm long. That is, if we are rejected by the 300-day moving average, the 250-day moving average, the 200-day moving average, the 30 RSI levels. I want to see the prices go down there and reject those levels. That gives me a good risk to reward ratio and a good structure for the trade to make my trade based upon that line in the sand, upon that level. If I'm right, then I have a nice upside potential. If I'm wrong, I can be out quickly for a small loss. There's always a chance I'll have a major loss, but I adjust my position size accordingly to the volatility of the market, and I place my emergency stop well outside of that range. And if it does get to the emergency stop, then I know exactly how much I'm going to lose, and I'll get into that in a minute when we go through the trades. But looking for levels to be rejected, offering a good risk to reward ratio, position sizing based upon the volatility, placing an emergency stop, and then placing an end of day stop. In about 95% of my trades, if I have a loss, they will be small losses. The 5%, yes, could hit my emergency stop, which would give me my maximum allowed loss, but my maximum allowed loss is only going to be 1% of my total capital, so it's not going to be something that devastates my account. Now, to the upside, I always take partial profits when it goes in my direction. Not everything, but just a partial. I like to play offense in the emergency stop, the end of the day stops. That is considered defensive moves. But taking profits when it goes my way, that's considered an offensive move. Now, when it moves 1.5 ATRs from my entry point, then I start to tighten up my stops. I go into trailing stop mode, and I'll show you that when we go through the trades. All right. So now, on these dailies and these weeklies that I'm looking for, majority of time, we're not really even going to be close to those levels, and I'll just have to wait and be patient for the markets to come down to those levels that I'm looking for. If they don't, then I'm just not going to trade, and I'll look for a different kind of market. All right. So I have identified some potentials for next week on the daily. Also on the weekly, the market really has been rallying here, and my choices of trades have been limited because we've been in such a rally mode. So, but there are some, and I will go through those when we get to that point in the podcast. All right. So, all right, I have to run the U.S. legal disclaimer. Hang tight. I'll be back in about 40 seconds. Thank you so much.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right. Thanks for holding on with me. So I am house sitting out of town. I've been down here in Las Vegas, in Henderson for about a week. It's been really nice in this really nice gated community and have access to the country club. It's been pretty cushy, I'll tell you that. Nice and quiet though. And so I'm not sure how long I'm going to stay. Maybe another week, maybe longer, but really enjoying it. All right, let's get started on the current trade. So Friday, I did take a short position in Lyft, LYFT. Now, I've been waiting and waiting and waiting on this particular trade. You can see on earnings, we had this big gap down. And we've rallied, we've closed the gap. All right, that's not the main reason I took it. I'll show you why I took it, but it definitely layers into why I took it. But I did get short here, Lyft Friday at 10:55 for multiple reasons, as a matter of fact. One, we have a V1 entry trigger to the downside, a bearish V1. A V1 consists of two bars, bar 1, bar 2. You see how bar 1 went above bar 1's high and then closed below bar 1's close. That is the entry trigger. Now, in addition to that, from an RSI perspective, we went all the way up, tested the 70 RSI, and then came down below. So we had an intraday rejection of the 70 RSI. About 92% of the time, the 70 RSI level is about it. And you can see we've had this really extended rally here. So for the market to go up, test the 70 RSI and fail, and in addition, have this V1 reversal entry trigger, really good. Over here, we have a high here. This is an order block. The low of the order block on Friday was also rejected. So a nice confluence of signals on this short. Now, my stop on a V1 is halfway of the washout bar, a little bit lower here, right about here. Dovetails right about with that 100. But my stop, if it moves back up, will simply be a close over halfway of Friday's bar. From a Fibonacci standpoint, this 50% is an important level. So if it on Monday, for example, if it closes above halfway of this washout bar, which is about 1075, then I will just go ahead and exit the trade. Now, you see the orange line down here. This is 1.5 ATRs below my entry. If it does move down to this level, then I will go into trailing stop mode, which means that if I get a close, if it moves down to this level and then I get a close above a previous bar's high, I will exit half. Now, I talked about position sizing, and position sizing is very, very important. And let me show you exactly. So let's just use, this is based upon your account size. Let's just say I have a hypothetical $100,000 account. $100,000 times 0.01% is $1,000. If you have a $50,000 account, then 1% is 500. If you have a $1 million account, 1% is 10,000, and it works the same. So hypothetical $100,000 account times 1% is $1,000. I divide that by the value of the 2 ATR. ATR means average true range. You take the average true range times it by 2, and it's 88 cents. So 1,000 divided by 88 cents tells me to buy 1,136 shares in this hypothetical example. Now, this line up here is my emergency stop. If it just races up on Monday and gets to that emergency stop, I'm going to go ahead and just get out because I have 1,136 shares. If it moves 88 cents, that's my $1,000. Now, most of the time, I base all of my entries and exit based upon the closing price because the closing price is the most important price. And so the halfway, the daily stop, end of bar stop on this, as I mentioned earlier, is a close above halfway here. So Monday, if it barely closes above there, I'll just go ahead and get out. The loss certainly will be not $1,000, because if I get up to my emergency stop, then I do not wait for the end of the day. If it reaches it, I get out immediately. So I've adjusted for the position size. Well, let's start from the very beginning. I was very patient on this trade. Patience is a huge part in trading. And again, why did I take the trade? Well, we had a V1 reversal to the downside. Bar 1, bar 2 goes above bar 1's high, closes below bar 1's close. Okay, that's the main entry trigger. In addition to that, we went above 70 and below 70. We also rejected this order block from over here. So I have all sorts of confluences to tell me this should probably go down. Doesn't have to, obviously. And I position size correctly, take 1% of my total capital divided by the value of the 2 ATR. That shows me how many shares to buy. I have 2 stops. I have an emergency stop up here. Do not wait for the end of the day or the end of the bar for that to close. If it ever touches that, I am out. I've lost $1,000 because I position sized using that math. End of day stop, close above halfway the washout bar. These are the risk levels that I'm talking about. Now, if it goes my way and it moves the value of 0.45 ATR, which now is 20 cents. So I take the closing price minus 20 cents, because that's 0.45 ATRs. Then I would take off 10% of my position on the way down. So you have to play offense and defense. Defense, position sizing correctly based upon volatility, placing your emergency stop, placing your end of day stop. Offense, taking partial profits if it moves your way, having a level that you go into trailing stop mode with. And by the way, if you'd like to learn more, this is a V1, but I also use V2s. If you'd like to learn more about V1s or V2s, I have a instructional video on YouTube in my lessons playlist in the Gossett Trading and Mentoring YouTube channel. Go ahead and watch that. That's been a real popular video and will explain to you more about V1s and V2s. And by the way, as I show you these positions and these trades today, you may say, oh, Gregg has a lot of rules. And I do, but they're there for a reason. I do offer private one-on-one lessons in the evening time via Skype. I teach a great course. It's a 15-hour course, 5 sessions. Each session is 3 hours, and I teach you all 5 of the different trading approaches that I use. I teach you step by step. I have taught people from all over the world, from beginners all the way up to serious hedge fund managers, and I love to teach. I always try to do my very best for my students, teach them a skill, and if you are interested at all, I'll talk about it more at the end of the podcast. But if you're interested, my email is in the link in the description. All you have to do is reach out to me, and we can set up a Skype call, talk about it. But it's a really good course. I've been trading for 28 years, and I show you everything that I've learned over the last 28 years. But check out that video on V1s, V2 entry signals. They're really bread and butter of my trading. And again, that was the trade. V1 entry trigger to the downside, rejection of the 70 RSI. It's also a lower high. When I short, most of the time I will short from a lower high perspective. A lot of times when I buy, I will buy from a higher low perspective. But so that's it. Slightly in the money on this trade at the moment, about 1.05%. IWM, man, I have been in this trade for a long time, but it's a really good example, good teaching example of why I bought this. One of the longest trades I've had in a while. I bought this all the way back on the 14th of October in 22. Now, at the beginning of the podcast, I talked about looking for levels that get rejected. Well, you see the orange line here? This is on weeklies. Lift is the only daily trade that I have. So we switched over to weeklies here, weekly bar. So each bar is a week. So I bought this all the way back here at 167.19 at the end of the week, because Friday, weekly bars close on Friday. We went below the 300, closed back above it. Okay. And why is that important? Well, that's important because it showed me that the market did not like any prices below that point. And so I position size, taking my maximum allowed loss, dividing up by the value of the 2 ATR that showed me how many shares to buy. You can see my emergency stop way down here, right? Now, where's my end of day stop? Well, or end of week stop. Why did I take the trade? I took the trade because it rejected the 300-week moving average. If the next week had simply closed below this 300-week moving average, I would have gotten out for a small loss, right? That's all there is to it. I have my emergency stop down here. We talked about that. But end of week bar, if it had simply closed below the 300, I would simply have been out. Now, I placed my 1.5 ATR trailing stop level above. And as I mentioned before, if it moves the value of the 0.45 ATRs from the last bar's close, I take partial profits. Well, the next bar went up, I took some profits. Next bar went up, took some profits. Then I got to trailing stop mode here. Now, if I have a close below a previous bar's low, I will get out of half. That happened here, 178.70, and I took half of the remaining position off for a gain of 6 let's see, is that right? Yeah, 6.53%. Now it headed back down. Had it closed under the 300-week moving average, I would have simply gotten out. Then we had another month and a half rally to the upside, and I continued to take profits. I took profits here, I took profits here, and I took profits way up here as well. So I continually am reducing my position size and reducing my risk. And then we came back down and I said, well, this time for sure, I'm probably going to get stopped out with the remaining shares. Bounced here at the 300, closed above. Next week went down below again, closed back above, and kind of moved sideways here for about a month and a half. And then the last couple weeks, of course, we've had this nice big rally. So the remaining shares that I have from entry to current price up 9.61%. So this is a really good teaching example of using my rules, why it's important to scale out on the way up, trailing stop levels, taking advantage of big rallies here. You know, you can imagine I took a lot of the shares off here, and then when it came back down, I was like, whew, I am really glad I did. But right now, that 300-week moving average is definitely acting as support. It held as support here, held as support here, held as support here. So the market really does not want to go below the 300-day moving average, about 172.80. So anyway, remaining shares on IWM up 9.61%. Another good example of buying fear, but buying fear based upon a structure and a level, is XLF. I bought XLF back here on the 24th of March. Purple line here is the 250-week moving average. On this week, during the week, we bumped into it but closed back above. That shows me that the market did not want to go lower than that. So I position size, I entered at 30.71. I placed my emergency stop 2 ATRs below. My end of week stop would simply be a close below the 250-day moving average. I placed my 1.5 ATR trailing stop level above my entry. Next bar moved up nicely, took some profits off. Next week, nothing. Next week moved up, took some profits off, and I got to trailing stop level, which means that now if I have a close below a previous bar's low, I will simply get out of half. Well, we went below but closed above, went below, closed below. We never got a close below the previous bar's low yet, so I'm still in the trade in the full position except for the areas that I took profits off of. So if in the future, if I get a close below previous bar's low, I will get out of half. But this particular trade here, doing very nicely, up 7.42%. Next one, XLRE. All right, well, this is a higher low V2. Earlier in the podcast, I talked about what a V1 is. This is a V2. Bar 1, bar 2. You see how bar 2 goes below bar 1's low and then closes above bar 1's close. This is called a V2. But the more important part here is this is a higher low V2. Higher lows, if you're bullish, are always better. Lower highs are better if you are bearish. And what does it mean by higher low? Well, look, here we had a low, We rally into the value zone. The value zone's anywhere between this green line and this green line. So we rallied in, then we pulled back, and then we formed a V2. Bar 1, bar 2 goes under bar 1's low, bar 3 closes above bar 1's close. I got long here, 36.32. My position size, I placed my emergency stops 2 ATRs below, as always. And my end of day stop is halfway of the washout bar on the V2. Here's the washout bar that washed out bar 1. Halfway here, 35.79. If this week had closed below halfway here, I would simply get out for a loss, most likely a small loss, but it went my way. It moved up. It did not move up the value of 0.45 ATR, so there was no profits to be taken off the table yet, but still, this particular trade doing pretty well, up 2.07%. And again, if I move to the trailing stop level, which is 1.5 ATRs above my entry, then I will go into trailing stop mode. So this particular trade up 2.07%. All right, Netflix. Well, boy, I thought I had a really good trade on my hands here, but the market, especially the Nasdaq, has been too tough. I did short Netflix at the end of last week with the rejection of this 200-week moving average and a rejection of the 70 RSI, very similar to Lyft. So I got short here at 404.65. I position size. I placed my emergency stops 2 ATRs above. So what that means, if it got up there, I would lose 1% of my capital. My end of week stop was simply a close above the 200-day moving average, 200-week moving average, excuse me, and that's what happened. So did I lose? Down 3.59%. Did I lose 3.59% of my capital? Absolutely not. If it had got to my emergency stop, I simply would have lost 1%. Well, it didn't even get halfway to that. So that's why position sizing, the way that I do it using the 2 ATR and the position size, is really such a great way to go, because it gives you plenty of room to breathe, and it shows you exactly where to get out if you're wrong. But this one, I was wrong. Had a loss on this particular trade of 3.59%. All right, so that's the end of the weeklies. Monthlies, I really like this trade, everyone. I like to trade multiple time frames. This is on Love, Southwest Airlines, Love. Each bar that you're seeing here is a monthly bar. So to enter a trade on a monthly bar, you do it at the last day of the month. Well, look, Southwest Airlines in recent history went $64 down to $28. I mean, I don't think Southwest is going out of business, but glad I didn't buy up here. I was just looking for a level, and I was just patient to come down to this 200-month moving average. I bought it here on the 31st of May when we went under during the month and then closed back over the 200-month moving average. I did get long here at 29.60. I position size by taking 1% of my capital, dividing by the value of the 2 ATRs. That's this line down here. If it got all the way down to this line here, I would only lose 1% of my capital in the worst case scenario, disregarding some kind of big gap or something like that. But still, this is very far below my entry. My end of month stop is simply a close below the 200-week moving average. So, yes, I could have a loss on this trade, but if even if we close $1 below the 200-week moving average, it would be a very small loss. And the other thing I like about this is that, of course, we are in this downtrend here. Well, now we started to move sideways. We started to look, we had some sideways motion showing that there was some an equal amount of buyers and sellers, not rallying strong, but at least it stopped moving down. So I did get long here at 29.60, place my emergency stop below. My end of month stop would simply be a close below the 200-month moving average. Now to the upside, orange line, 1.5 ATRs above here. If it moves up, and these are monthly bars, so I could be in this trade, 2, 3, 4, 5 months before it gets to this level, then I would go into trailing stop mode. We're also working on a V2. V2s work on all time frames. Bar 1, bar 2 goes below bar 1's low, and now bar 3 is above bar 1's close. So this is now a V2 entry in addition to rejection of the 200-week moving average. So I'll make a decision on this at the end of the month if it closes below, but currently up 3.3%. So pretty good trades. Had one stinker in there. Lift on the daily short with the V1 to the downside and the rejection of the 70 RSI. Also filled the gap to the left here, rejected the order block there as well. This current position in the money, 1.05% on the weekly. On daily, excuse me. On the weekly, IWM up 9.61%. On the weekly also, XLF up 7.42%. On the weekly, XLRE up 2.07%. Netflix had the loss of 3.59% on the short. And then Love on the monthly up 3.3%. All right, let's talk a little bit about trader psychology before we start taking a look at setups for next week. This is from Anthony Crudelli, great futures trader, very popular channel on Twitter. You can follow him at Anthony Crudelli over on Twitter. Please do support his channel. He's a great trader and he puts out good information. Let's see what Anthony has to say today. I've noticed when new traders are making money, they're good risk managers. But when they're losing, they let their guard down. If there's one thing you can change in your trading, it's switch that psychology. Be aggressive when you're winning, defensive when you are losing. Isn't that true? I see this in poker as well. People play perfect poker when they're winning, but if they get a bad beat and they start not running well and doing poorly, they blow up. They go on tilt. I'm sure you've heard that, but it's the same with trading. So I've noticed when new traders are making money, they're very good at risk managers, but when they're losing, they let their guard down. If there's one thing you can change in your trading, it's switch that psychology. Be aggressive when you're winning, sure, but defensive when you're losing. If you are not doing well, if you are out of phase with the market and you're having a drawdown, of course you want to trade larger because you want to make it back, right? That's just human nature, but it's ironic, but it's the worst thing you can do. When you are doing poorly, trade smaller. When you're doing better, yes, then you can trade better. You can trade larger and more aggressive. But as always, be very patient with your winners. Be very impatient with your losers. And unfortunately, that's what most people do. They do the opposite. When they are losing, they bet bigger. When they're winning, they bet smaller. And it's really the opposite. So thank you for that, Anthony. Keep that in mind. If you are in a drawdown at the moment, trade smaller. Trade smaller until you start printing some black ink, and then you can get larger from there. But I've been trading for 28 years. I know a lot of traders have been trading a long time, and this is what they do. When they're trading poorly, they trade smaller. When they're trading well, they trade larger. All right, let's go over, take a look. Now, again, I don't have a lot of setups for this week because the market is so high. I have an indicator. I say this kind of jokingly, but let's take the Qs for example. And by the way, I do want to talk a little bit about the Qs after I show you the setups because there's some important levels. But when things start getting really high, let's take a look at NVIDIA. When they start getting really high up here to the point where they're reaching my levels up here, that's generally a sign that they're going to go down. I'm not saying that the market's going to go down from here, but we have had a very strong market rally. I know there's a lot of information out there on the media that we're in a new bull market, and they're almost advertising like this is a guaranteed bull market. Well, we are at some pretty important levels on the NASDAQ, on the SPY. We're up in the high ATR channels where we've rejected the 70 RSI multiple times now on the Qs. 92% of time, the rejection of the 70s, we head down. So I'm just adding some caution here. You've had this huge move up on AI, but please, everyone, trees don't grow to the sky. Of course, we have the Fed next week. They're expecting a pause on rates, so forth and so on, and all the stuff with AI. But this is, in my opinion, a lot of this is baked into the cake. So please be careful at these levels. Okay. So with that said, let's go over to gold. Now, gold, again, got up near the 70 RSI level up here, and now look where it's at. Right? Doesn't mean the market's going to do that, but everything seemed really great up here. Now not so hot tamale. So what I'm looking for next week, haven't talked about crossovers in a while because of the market, but a good back-tested approach to trading GLD to the long side is when the 5 EMA, this is a small blue line here, crosses over the thicker blue line here of a 520 cross. This is a good back-tested approach. It does back-test well profitably over time. But next week, if the 5 EMA closes above the 20 EMA on a closing basis, that is a legitimate entry. And again, this is another one of the approaches that I teach in my one-on-one courses. Have not had this lately, or too many of them lately, so you haven't heard me talk about them, but this is one of the 5 that I use and that I teach in my one-on-one course. So this is what I'm looking for next week. And after the Fed meeting, we could have a change in the market, could spark some interest in gold. I don't know. But if it does, it will go up and the 5 will cross over the 20. And what I like about this here, I like crossovers that come from a sideways motion. You see how we're moving sideways here? In my experience, the best crossovers come after sideways motion and then they cross over. Some of the time, you'll get a really nice big trend. So on GLD next week, what I am waiting for is the 5 EMA to close over the 20 EMA. That would be my entry signal on GLD. Coca-Cola almost took this trade on Friday, but it didn't quite get there. Now, you've heard me talk about higher low V1s, V2s. There's also a thing called a higher low close under, close over the 200. Well, here, look, we had a close under here, and then we closed over the 200. Was that legitimate? Yes, it is legitimate, but it comes from a lower low perspective. You see how this low is way lower than any low in the past. And so a lot of the times, lower low closes under over the 200 fail, just like this one did. But now this, you can see the 200 is at 60.48. We closed at 60.47, just a penny off, but it was not strong enough to close over the 200. I want to take a position in Coke if it closes over the 200, so that I have the support of the 200 beneath me as support instead of resistance, because right now it's 60.47, the 200 is 60.48. It is technically still above us as resistance. So, but the key here is that if we do close above the 200 next week, it will come from a higher low. This one came from a lower low, closed above and failed. But if we close, say, Monday, for example, over the 200, you see how this low is higher than this low? Higher low closes tend to trend. Lower lows tends to bounce and fail. Does that make sense? This was a close under, close over the 200, but it came from a lower low. This one, if it comes Monday or anytime next week, closes above the 200, it would have come from a higher low perspective and therefore a better chance that it would rally. Okay, now if it closes up here, yes, it's a close above the 200-day moving average, but it's too high. Now the risk to reward doesn't make sense. Ideally, what I would like to see, I can manipulate this bar. If this would have closed like this on Friday, of course I would have bought it for sure, because it's a close under, close over the 200, came from a higher low perspective. And so from here to the black line, the 200-day moving average, it gives me a good risk to reward ratio. So if it had closed like this Well, yeah, no way I'm going to take that because my risk is here all the way down to here. So it's kind of a fine balance of, how much is too chasey, how much is how if it's too far above, just a nice gentle close above the 200, mainly that it gives me a good risk to reward ratio while still having the support of the 200 below. So I'm looking for a nice gentle close above the 200 next week, especially becomes from a higher low perspective. So that's what I'm looking for on Coca-Cola. Lockheed Martin. Well, this one would have been a good trade. I didn't take this one. Obviously, I wish I would have with the close under, close over the 200 because it's really gone up nicely. But now it's too high for me to buy here. Where do you think I'm looking for this to come back to? The 200-day moving average. And is there a chance? Absolutely, there's a chance. It's had a huge extended move. A pullback would be great, but I'd like to see it come back to the 200-day moving average, go under during the day, close above, nice gentle close above, or just a bounce and close gently above to give me a good risk to reward ratio. So this is a good example here of going, look, this is the level that I'm looking for. Some kind of rejection next week of this 200. If it does, and it's a good risk to reward ratio, then I'll consider taking it. If not, I'll just move on to another market or just not trade at all. But that's the key with patience, is identifying an important level like this 200-day moving average where buyers most likely will come in. Does it give me a good risk to reward ratio? If it does, then I'll take it. I'll position size. I'll place my emergency stops 2 ATRs below. If I have a close underneath the 200, I'll simply get out. If I take the trade and it moves up, I'll take partial profits along the way. If it moves 0.45 ATRs from the previous bar's close, I'll take off 10%. If it gets to my trailing stop level, then I'll go into trailing stop mode, right? So you have to know exactly what you're going to do regardless of what the market does. You don't know what the market's going to do, but you have to know exactly what you're going to do, whether it goes up or down. Regardless of how far it goes up or go down, you have to have a plan. And, that's part of your process. You have to know exactly. And like I said, that's one of the things I teach in my class. I teach you exactly what to do in any trade whatsoever using good trading principles. So just to recap on LMT, looking for a pullback and rejection of the 200. If that happens, I'll consider taking the trade. If not, I'll just move on to something else. Nike. Well, Nike has not participated in this market's rally whatsoever. Look at this move down. Unbelievable. Boom, 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 boom. Okay, what level am I looking for Nike? Well, right now we are at a 34.89 RSI. The 300, the 250, the 200 are well above us. That's really not what I'm looking for. What I'm looking for is a move back down and a rejection of the 30 RSI level. 30 RSI level is not shown anywhere other than here with my level, but the 30 RSI is a really good level to base your trades off of. Let's say next week it goes down, it goes under the 30 RSI during the day and then closes at like a 31 RSI. Well, I would take that trade, because if it then in the future it closes under the 30, I just simply get out for a small loss. If I'm right, I could have 2, 3, 4 times to the upside on that. So what I'm looking for next week, if and only if this happens, is if we either two things. We close under the 30 RSI and then we close back above. That would be a close under, close over the 30 RSI, or an intraday rejection of the 30 RSI where we go down, we go under the 30 RSI and close back above. In addition to that, what I can see forming on Nike is a double bottom bullish divergence. See the low that we have here with the deep red MACD bars? Red MACD bars are momentum indicators. Obviously, lots of downward momentum. Now we've rallied into green. You see how we have some green here? If we do come down to a 30 RSI, we most likely will test this previous low, but I can tell just from experience, I can tell that even if we get down here, we may have some red, but the red would be very shallow compared to these deep red bars here. That's called the double bottom in a bullish divergence. And I learned this from studying one-on-one with Dr. Alexander Elder. And really all that means is if we do come down and test this low with less red MACD, that means we're running out of downward momentum, or we're running out of sellers. And if you run out of sellers, market goes up. If you run out of buyers, market goes down. So I really like this potential trade on a large, strong company like Nike that's out of favor at the moment, but I still needed to get to the level that I can base my trade on, which at this moment right now would simply be next week if we continue down, or either a close under the 30 RSI, back over the 30 RSI, or an intraday rejection of the 30 RSI. And cherry on top with this trade, if that happens, very likely we'll have a double bottom and a bullish divergence. So let's just do a recap on the dailies for next week that I'm looking for. GLD, gold, looking for a 520 cross as a potential long entry. Coca-Cola, looking for a nice gentle close above the 200 for potential long entry. Lockheed Martin, extended above the 200, but if it comes back down, if and only if it comes back down and rejects that 200, I will look for potential entry there. And again, on Nike, next week, some kind of rejection of the 30 RSI level. All right, those are the dailies that I'm looking at next week, for next week. Now let's look at the monthlies. I'm sorry, the weeklies. Only a couple. Only a couple. I went through them all, but this is what I have. This is Bitcoin, BITO. This is setting up nicely for return to value V2, one of my favorite approaches. Now, this is for next week only. This is called a return to value. Well, look at the two green lines, this green line, this green line. This is the 1 ATR channel. This is the -1 ATR channel. Return anywhere in this channel of green is considered the value zone. You don't want to buy above the value zone. I know a lot of people like to, because if it's up there, it means that there's good news, but it's better to buy in value, sell above value. You can see right here was a decent place to buy in value, wasn't it? Well, I don't want to buy up here, but look, we've returned to the value zone. We came down and we returned. We have 3 bars of sideways motion. Now we have this big move down. Well, this is forming a potential V2. Here's bar 1. Did bar 2 go below bar 1's low? Yes, it did. If and only if next week we close above bar 1's close, which is 1529, then we will have what is called a return to value V2. These perfect setups don't come along very often, but this one is here now. But we still need the price to move up above bar 1's close, which is 1529. So next week, if we close above 1529, we will have a confirmed return to value, sideways motion, false breakout to the downside, reversal back up, and we potentially could go back up and test previous highs. But again, if and only if we form a V2, and the only way we'll form a V2 next week is if we close above 1529. I'll just show you very similar to my XLRE trade. Bar 1, bar 2 went below bar 1's low, bar 3 close above bar 1's close, higher low. This is different. This is a higher low V2 where the Bitcoin was a return to value V2, but both great and both completely legitimate. So I will be watching BITO very closely for a return to value, sideways motion, false breakouts to the downside, and a potential V2 entry trigger. And then that last one, natural gas. Well, natural gas has come down biggies, right? Big. But now we are starting to form a range where we're kind of holding and moving sideways. So what is my level that I'm looking for? Well, we're at a 33.95 RSI. I will simply be looking on a weekly basis by next Friday. Did we go under the 30 RSI and close back above the 30 RSI? Simple as that. In addition to that, we have a lovely double bottom bullish divergence. Here's the low. Look how deep the red bars are. Then we rallied. Now we have green bars. Now we are lower here than we were here, but you see how there's no red bars? This is called a double bottom bullish divergence. It's showing to me that we're making a bottoming process, but I don't just go ahead and rush in to buy. I still need a legitimate signal. The legitimate signal would be an under 30, over 30 on the week, and that would get me long. So only 2 on the weeklies. BITO, Bitcoin, return to value, sideways motion, looking for a return to value V2 if we close above 1529. And natural gas, double bottom, bullish divergence, but still need the entry trigger of an under 30 over 30 on the weekly. So hope that was helpful there on the potential trades. I do want to show you on the Qs. A lot of talk about the Qs. And this is a little bit of a struggle here because this was so far back. But there's things called fair value gaps. And there was a fair value gap on the Qs. Yeah, boy. Let me see if I can do this. Very important level all the way back here in January, February, March, April of 2022. There's a gap. I know you can't see this very well. You're just going to have to trust me. There's a gap here between 357 and 362. There's also an order block here at 366. So these areas right here, and to start with, this bottom fair value gap, could be quite a lot of resistance here. So you can see I'm basing it upon the gap from here to here and then the order block here. Now I'll go back into real time or into current prices. And so that line has been extended. Look here, let's see, that's Friday, Thursday, Wednesday, Tuesday, Monday. Monday, we tested that bottom gap level, went above it, failed. Tuesday, slightly up or down, can't tell. Wednesday, we tested that level again, the 357 level, and sold off hard. Thursday, we moved up again. And then the key here is on Friday. Do you see how we got to that level again intraday and then close back above? So we've had 1, 2, 3 tests of that gap level, and we didn't like it. In addition to that, RSI is 64.45 on the Qs. During the day, we were above 70 RSI. So this is showing to me that we could potentially be at a short-term top on the Qs because we rejected the 70 RSI and we have tested this level. In addition to that, take a look at the high we have over here on the 5th of June. RSI was above the 70. We went higher on Friday, and do you see how now we are under 70? This is called a RSI divergence, where we went higher, but the RSI is lower. So this is telling me very likely that we could be at a top on the Qs. Now, next week we have the Fed meeting. Certainly with the right verbiage, this could go way up from here, but it also could go down. There's a lot of things baked in the cake potentially in this market. So don't be surprised, even with good news next week, if we go down, because the technicals are telling us that the market does not like this gap. Tested it here, went down, tested it here, went down, tested it here, went down. We also have an RSI divergence. We also lost the 70 RSI. So, if you're doing well in the NASDAQ stocks, congratulations. Very happy for you, but please remember from a technical standpoint here that we have rejected some important levels. All right. So earlier in the podcast, I talked about that I do teach private one-on-one lessons in the evening time via Skype. I love to teach. I've taught people from all over the world. I teach a really great course one-on-one. I think the best way to learn anything is one-on-one with your instructor. And that's why I format the lessons this way. Lets you ask lots of questions. You don't have to worry about taking up time from other people, so forth and so on. But if you are interested, if you would like to learn the skill of trading, I would be very happy to teach you. Like I said, I really enjoy teaching. I've learned so much in my last 28 years of trading, and I really enjoy teaching people all the 5 different trading approaches that I use. So if there is any interest, the course does cost $1,750, but I promise you it's worth every penny in what you're going to learn and the attention that you get. All you have to do is reach out to me, send me an email. The email is in the link of this YouTube video. I'll reply and say, hey, great. Thanks for saying hi. Let's set up a Skype call. Skype call's free. I promise you it is not a sales call. I just want to learn more about you, your trading, your challenges, and your goals. And it's also a great time for you to ask me any questions about the course. And when we're done with the Skype call, then it's on you in the future. If you decide, hey, I really want to take this course, just email me back and we'll get it scheduled. But it's a great investment. You are going to learn a lot, and look forward to teaching you if you decide that's what you want to do. If you like today's podcast, I would really appreciate it if you could hit the thumbs up button. It does help to build the channel, keeps the channel around, lets YouTube know there's some valuable content here. And so if you learn anything valuable today, would just appreciate a quick thumbs up. Most importantly, everyone, try to go out and do one nice thing for another human being today. You know, it's good karma. It would make the world a better place. You know, if somebody does a nice, kind gesture for you, you know, you appreciate it, and then other people appreciate it if you would do it. But it really would make the world a better place if we all did one nice thing for another human being. And if you could throw in doing something nice for an animal as well, they appreciate acts of kindness as well. So one nice thing for human, one nice thing for animal would make the world a better place. And I forgot to mention, if you like online courses, I have a great online course available at udemy.com. It's called the Deep Dip Buy Stock Trading Strategy. It's super affordable. It's between $12 and $15. I teach you how to trade the Deep Dip Buy Stock Trading approach. Step by step. I've sold so many of these around the world, got so many good reviews, so much good feedback. So that's a really good place to start, and the link to that is in the description. So I hope you enjoy the rest of your weekend. Please be careful as always. Please remember that on the indexes here, we are at some important resistance levels, and trees don't grow to the sky. Doesn't mean go ahead and short the market or anything like that. It just means be careful. There's a lot of exuberance in the market, and a lot of talk about guaranteed rallies and so forth. There is no such a thing. So just kind of felt moved to tell you that. So thank you so much, everyone. Appreciate you. And God willing, I will see you next weekend. So enjoy your weekend and trade well next week. And on the way out here, I have to run the U.S. legal disclaimer. Thanks again, everyone. Take care.
Government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation, and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance Result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.